Hello everyone and welcome to this week's FX update. My name's Craig Earlham, Senior Market Analyst at OANDA. For those of you who didn't join us last week, Happy New Year. I hope you all had a fantastic festive period. You've come back refreshed and have had a good first couple of weeks of the year. It's been really interesting from a markets perspective. That probably comes as no surprise to many of you who followed the markets in the lead up to the end of the year. It's been extremely volatile across various asset classes, which is always interesting from a market observance perspective, and it makes things interesting from a charting perspective as well, it's safe to say. Now, as far as this week is concerned, it's looking relatively busy. I think it's safe to say that there's a number of issues that have gone some way to resolving themselves. There's been improvements in other areas. For example, the Italian debt standoff between Rome and Brussels has resolved itself with both parties coming to an agreement, which is positive from a risk appetite perspective, simply because it removes one of the obstacles really for investors and one of the areas which I think contributed to the market sell-off in the back end of last year. We've also seen positive progress with US trade talks with China. Early last week, we was meant to be a meeting at a more junior level between the US and China in Beijing. That extended into a third day. Both sides expressed optimism around the talks, which again is very encouraging. Obviously, the prospect for an actual trade deal or a broad trade agreement in this 90-day period is slim. But as long as we get enough from these talks, which suggests that both sides are working towards an agreement in the longer term, maybe the extension is the deadline is extended, no more tariffs are imposed, maybe even some reversed at some point in the not too distant future. Very positive for risk appetite, very positive for the global economic environment right now, which is shaky at best. People very much revising down global growth forecasts, and we've very much seen that reflected. I believe the movements that we saw over the Christmas period were probably exacerbated very much by illiquidity in the markets. I think the moves were vastly exaggerated in certain cases. We obviously saw the yen flash move over this period as well, and to make matters worse, that came around on a Japanese bank holiday, and also in what is known as the witching hour between the US close and the Asia Open, when you typically get low levels of liquidity as well. So it wasn't exactly, it was quite an eventful period for what is typically an uneventful time of year. At the start of this year, I think there's very clearly two stories which have really grasped the markets. Obviously, the trade thing is still very relevant, but it's an ongoing story. The one that's really grasped over in the US has been the government shutdown. Now, the economic, this is very much a political battle. Now, obviously, it's easy for me to talk about the economic implications being minor, but for the 800,000 people who are not working and not being paid, that is a very different situation altogether. We're probably going to see that have implications for the data in the near term. Maybe even the jobs figures, I believe, could be impacted by this shutdown, which is now the longest in history. Whether that has a broader impact on first quarter data, I'm not entirely convinced at this stage. For one, whether it's going to last long enough to. We are only now in mid-January, but also I think the data in the first quarter is typically quite weak anyway, so I don't think we can necessarily attribute it just to this standoff in Washington alone. The other story, and I apologize if this is going to bore people to tears, particularly those who are not inside this country, but it's quite clear that the biggest story right now is Brexit. We are now hitting a crunch period, and believe me, if those of you who are outside the UK and then watching from afar aboard of this, you can only imagine what it must be like for the rest of us. Day in, day out, constant news flow, so much politics being played, processes being played out. It's I think there's not going to be many people who aren't going to be delighted to see the end of this. But we are very much in a crunch week now. And we are in a period where we're going to see a vote in Parliament, assuming, of course, Theresa May doesn't cancel it again. Of course, they did cancel the vote back in December, very late in the day. So it could still happen now. We are now at the end of the 5-day period of debates, and the vote is expected to take place sometime after 7 p.m. tonight. Now, Theresa May is widely expected to be defeated on this. That's not to say her deal won't get over the line eventually, but parliamentarians know full well that a vote is going to come back to Parliament at some stage. They know that they can afford to vote this down without risking the country's outlook, without risking no-deal Brexit. Efforts are being made behind the scenes to make no-deal Brexit impractical, and I think eventually there is going to be enough efforts made to make it impossible. But at this moment in time, it's just being made harder. That, to an extent, will weaken the hand of Theresa May, undoubtedly. But it also does offer some support from the pound, which we will see when we come to the charts. As far as today is concerned, yes, we're expecting a defeat in Parliament. The reason being, there's a number of MPs who want a second referendum. And if they want that to happen, then Theresa May's deal has to be voted down. So then they're going to vote against the deal. The Labour Party want a general election. They believe that they can negotiate a better deal with Brussels. So they are going to vote this down. There are the hardline Brexiteers who don't believe that this deal goes far enough in Britain's interest and delivers on the referendum. Many of them are expected to vote this down. And then there's those who just do not accept the backstop as being part of this deal. The backstop, which says that at the end of the transition period, if no trade agreement has been agreed between the EU and the UK, then the UK enters into this backstop, which could in reality be indefinite until a deal is agreed. That doesn't deliver on Brexit in some people's eyes. So the sovereignty aspect, So there are a number of people who are looking to vote this down. A number of those may change their minds over the next couple of months if we get a general election which Labour loses, for example. If either a second referendum gets rejected by Parliament overall or gets rejected by the public, then people will have to decide how they vote on Theresa May's deal then. And also if public pressure as well ramps up in the interim, there's other alternatives as well, known as Norway Plus, for example. If that's rejected, then the people who are backing that may have to look more seriously at Theresa May's deal when it increasingly becomes, rather than what it is now, which is Theresa May's deal or a second referendum or a general election or Norway Plus, or I'm sure there are other alternatives out there as well. Once we start going through this checklist, and I keep saying this to people, I feel like what we're operating on right now is a game of chess. People are thinking 4 and 5 moves ahead. And there's also a checklist action as well. We've seen the vote of no confidence in Theresa May. That failed. Check. Next, if we do see Theresa May's deal fail today, that's another check. Then we're like in a government led by the opposition Labour Party. Check. And so on and so forth. And eventually, once all the boxes checked, all you're effectively left with is 3 options for Parliament. One is Theresa May's deal, or a slight variation is no deal Brexit. More than 3/4 of MPs have voiced their opposition to that. So this is not something that's going to be voted on in Parliament. The third option would be withdrawing Article 50, which the ECJ recently stated can be done unilaterally by the UK. I very much struggle to see this as an option without a second referendum. So it feels like we're just moving through a process here, and the EU is very much aware of that. And while we're moving through that process, the pound is likely to remain extremely volatile. Now, I think to an extent, upside and downside is limited. So, for example, take today's vote. If the vote is rejected, that doesn't, in my view, increase the possibility of no deal because there's so much opposition to it in Parliament. So I think any downside is going to be limited. In terms of the upside, it very much hangs on the margin of the rejection. A strongly rejected deal, say 200 MPs, 150 MPs or more, would suggest that Theresa May is going to find it very difficult to get this deal through Parliament later on towards the back end of the first quarter, maybe even if there's an extension back towards May time. That suggests that there's a huge swing that she will need to get this over the line. So that could take some of the edge off the pound, but again, to a limited degree. The flip side of that is, if we see a fine margin, say 20, 30, 40, 50 votes losing by, that is not many MPs that need to be convinced that Theresa May's deal is the right option for the UK and the only feasible option on the table. That could simply come by Labour, who are currently opposed to Theresa May's deal, losing an election or losing a vote of no confidence and seeing Theresa May's deal as the only other feasible option on the table. So the markets could look on this quite favourably. And then obviously there are different actions in between. Now, yesterday we saw the pound rally on the back of the EU offering their assurances to the UK, or their attempted assurances to the UK on the temporary nature of the backstop agreement. Now, this is not necessarily legally binding, although some have claimed, there has been claims that there are legally binding elements of this promise. Although it's so vague, I really struggle to see how something like this could possibly be enforced. It's also very loose language, saying that we want to progress with this as quickly as possible. And therefore, I don't think this language alone is going to appease many people. There was some suggestions that there are some Brexiteers who are willing to back Theresa May's deal now, and I think the combination of these two things has lifted the pound ahead of the vote. For me, that leaves the pound potentially vulnerable to a buy the rumour, sell the fact type scenario. So if Theresa May loses this vote by a decent but not devastating margin, then we could see a buy the rumour, sell the fact movement. So even though everything's roughly in line with expectations, it wouldn't surprise me to see potentially some weakness on the back of that. But it's so difficult when you've got 650 MPs in Parliament to really get an accurate gauge of how MPs are going to vote when push comes to shove. So for that reason and the unpredictability of it, I think the only thing that's really guaranteed around this vote is that there's going to be potentially extreme levels of volatility, and that's something that we should be aware of. Obviously, there is the possibility, albeit very small in my view, that Theresa May's deal actually gets approved, that Parliament approves Theresa May's vote by the majority. This, I think, would be very bullish for the pound. There's three reasons why that is. The first reason is that, for one, it gets a deal over the line. We know we're exiting on the 29th of March, and we know what deal we have. Two, that deal delivers on the soft Brexit option, which is seen as very business friendly and friendly for the economy as well. It offers the continuity of the transition, but also it builds towards close trading agreements with the EU after the exit from the transition deal, and again acts to preserve the economy. And three, it removes the uncertainty and the possibility of no deal Brexit, which has been hanging on the pound for quite some time. So those factors, I think, would see the pound be in my view, very well bid because of that. And I think you could see a very significant move to the upside on the back of that. The flip side of that is, I think the possibility of that is extremely slim. Now, we've had a couple of questions here. What is Norway Plus? So a rough outline of what Norway Plus, or what we've been promised Norway Plus is. Norway Plus is so Norway has a trade deal with the rest of the European Union. It's part of a small bloc which has a deal with the rest of the European Union. It has the benefits of remaining being in the single market, but also in a customs union. The flip side of that is they have to accept free movement of people. I believe they also have to contribute to the EU budget, and the flip side of that again, though, is that they can give 12 months notice and exit from that particular deal. That is something that the UK doesn't have as part of the agreement which is currently in place, because the EU doesn't want the UK invoking that and putting up a hard border on the island of Ireland between the Republic and the North, and thereby dangerously having an impact on the Good Friday Agreement and potentially causing chaos there. Now, this is being sold as a potentially feasible alternative to what we have on the table currently. I don't see it as a feasible alternative for two key reasons. One, if Europe does agree to a Norway Plus option, I very much extremely strongly doubt that they would include the 12-month notice period. If the EU were open to this, they would have given it to Theresa as part of the deal. She tried, she failed, they're not interested. Two, Norway Plus keeps us in the single market, which means free movement of people. It ties us to a customs union, which means no trade deals. being negotiated while we are in it. This doesn't deliver on Brexit. This would be seen as a betrayal as much as many other options. So from my perspective, I just don't see this as being possible. Whether MPs for some reason believe they can get additional concessions that wasn't possible as part of Theresa May's deal, I'm not sure. The plus aspect does add that ambiguity to it, but I don't see it as a feasible option. And I guess there's plenty which people have said over the last couple of years isn't feasible, which is materialized. So the important thing is it is an option on the table, and it is an option that does have support within Parliament. But then again, Parliament is strongly Remain. The public may have voted 52-48 to leave, but Parliament has always been the majority, a vast majority are Remain. And that's why there are elements pushing for second referendums and elections, trying to frustrate the process, etc., for that very reason. So Parliament may well see Norway Plus as a feasible option because it delivers the type of Brexit which they see as technically delivering on the referendum result, while we're retaining as close a tie to the EU as possible, and effectively not really delivering on the result because everything will remain very much in the same. I've also been asked, the vote is 7 hours from now. Yes, that is the case. So the debating will stop, I believe, at 7 p.m. and the vote will commence shortly after that. Different places are reporting different timings for when that vote will actually take place. The important thing, it'll be sometime after 7, maybe around 8, between 8 and 9 o'clock. And again, just be aware that the markets could be extremely volatile in that time. So that's the Brexit situation as it stands. Things will develop as the week goes on. Theresa May, if she loses a vote, has 3 days to come back to Parliament with a plan B. That's been reduced from 3 weeks or 21 days from a week ago due to a bill that was passed in Parliament which she was defeated on. So these things are now likely to progress quite rapidly. That means that, for example, this week we could see Theresa May lose the vote. We could see a vote of no confidence pushed in government, something that Jeremy Corbyn, the opposition Labour Party leader, has been very much suggesting over the weekend. Things could start to move rapidly, and again, what that means is volatility for the pound. For me, the rest of the events this week really do pale into insignificance in comparison to this. So Bank of England Governor Carney's speech tomorrow, how much of an impact will that have if Theresa May's deal is voted down? I'm not really thinking it will have too much, if I'm perfectly honest. Inflation data tomorrow, yes, it's important, but if Theresa May loses the deal tomorrow, are people really going to start factoring in more rate hikes next year or fewer rate hikes next year based on one piece of inflation data? I don't think so. We could see some movement in the pound, but I don't think it's going to be as sensitive as it ordinarily would be. The Eurozone's inflation data on Thursday, yes, that strikes me as being a little bit more interesting for the simple reason that the ECB is still talking about raising interest rates towards the end of the summer next year. I think that's going to be pushed back potentially even to end of summer this year. It's now 2019. I think that could still be pushed back to 2020. The economy has slowed over the course of the last 12 months. Germany is very much engulfed in that and has been weighed heavily again by the emissions testing, which has hampered the car manufacturing industry, and we've seen that evidence in other countries as well. But we've also seen a global economic slowdown towards the back end of last year, heading into 2019, where we're expecting slower growth across the globe. This is the US. This is very much evident in China as well. We saw the trade data yesterday, which very much confirmed that exports and imports had declined year on year. I do think there is an element of this which is front loading prior to the tariffs being imposed. So if you import a lot more and you export a lot more because people are anticipating tariffs, then the months that follow are going to be negatively impacted. So I think give this a few more months and see if this wears off. But what people are reading into it, which is fair, is that the economy is expected to slow, and that is going to impact global trade. Finally, on Friday, we do have things like retail sales from the UK. Again, really not thinking that this is going to be the biggest knockout event of the week, if I'm perfectly honest. And obviously, it's always worth keeping an eye on Fed speeches. So you can see here, Williams, Quarles, numerous Fed speakers throughout the week, coming on the back of a far more dovish rhetoric from the Fed, a Fed that's now going to be flexible, a Fed that's now paying attention to the markets and one that isn't necessarily intent on raising interest rates 3 times this year. That was revised to 2 in December, and don't be surprised if that's revised down again going forward. I think 1 rate hike this year wouldn't come as a surprise to too many. And I also believe that the markets did overreact again over Christmas. There was one stage over Christmas, and it wasn't just for 5 minutes. At one point, markets were pricing in a 0% chance of a single rate hike this year and a 1% chance of 3 rate cuts. That, for me, is textbook over exaggeration, and in times of illiquidity, that is the type of thing which we can see. So let's have a run through the charts. If no one's got any more questions, if you have, please do send them through, and I will come to them at the end. I'm aware that Brexit update has rattled on a bit, but unfortunately it is a major issue right now. It comes with extreme complications. I'm constantly being asked questions about what it means, what's next, why is it so confusing, and hopefully I've cleared something up, but I imagine it's probably caused more questions than it's answered. I'll give details at the end of how you can contact me if you've got any questions after the webinar, if you don't have them to ask now, if things come to you later. So hang around to the end of the webinar and I will give you some details, and you can always reach out and ask questions then. In terms of the charts, yes, we have been seeing some weakness in the euro over the last few days. I'm not really buying too much into this. I'm still very much more of a dollar bear than anything else. The reason being that the 2 factors which have been so evident at the start of this year, for me, are both very much bearish the US dollar, and I'm talking US related factors, not Brexit. One is the trade war. Like I say, improving relations with China, I think, is negative for the dollar. During the escalation point of the trade war, the dollar very much benefited because the US was seen as being less vulnerable to a trade war than China is, and other countries as well. Well, if that's true, then when the reverse is happening and trade relations are improving and negotiations are progressing well, you'd expect to see an unwinding of that trade, which would be bearish for the dollar. The other thing is, of course, a more dovish Fed is typically means less rate hikes, would typically be negative for the greenback. So I think that's playing out in the longer term. Yes, we are seeing a bit of a pullback, and we're not seeing as aggressive a move in the euro dollar pair as we are in others, simply because the euro is also looking a bit weak. The central bank is likely to become less hawkish. The economy is slowing, and we've seen things like German industrial production data, which has been very soft and caused much concern. At this moment in time, we're still finding resistance in that 50-61.8 fib level area. That is the long-term support as well going back here. We're seeing resistance on the way up. I still think this is bullish. We just may be a slow grind high compared to elsewhere. If we break through 116, that would be a nice little break, a nice little bullish signal as well. Ultimately, though, I would like to see a break through these kind of 117s, taking us through the 200 and 233-day simple moving average band. And that, for me, would suggest that we are the market continues to look bullish. That's not to say it's going to rapidly pick up pace, but that would confirm the bullish market for me, which I still view as being likely to materialize, at least in the near term, based on the facts. But again, maybe the weakness in the US dollar is going to be less evident in the euro compared to other charts. As you're going to see is very much the case with all sterling charts, this is susceptible to extreme volatility, and therefore in times like this, I tend to pay a little bit less attention to the technicals. That's not to say that I ignore them altogether. But if you know that a vote can have dramatic impact on the pound, if you know constant news flow can have dramatic impact on the pound, etc., then technical levels become a little bit less relevant. Now, we are running in some resistance around these kind of 129s, which is price support and resistance. Again, I wouldn't expect this to hold in the case of some very bullish news on that Brexit vote itself. I think 130 is just a nice, interesting level for the pound. More of a psychological level, really. If we do see the margin between the votes smaller than we expect, then there'll be if we can break through 130, then that would be a nice little bullish signal. But again, it all depends on the margin, so it's very difficult to find levels here when you're don't have precise figures to hand, and it's extremely difficult to predict what difference 50 votes will make compared to 100 votes compared to 150 notes, because what's going to happen is you see that knee-jerk reaction, and then emotion takes over. More of a knee-jerk reaction takes over, stops taken out, so you can see the move exacerbated over time as well. So I think this is just, for me, I think the downside is easier to anticipate. For example, if we come back towards these 127s, I'm not sure we're going to see the momentum to drag us lower. The reason being that how bad can the news be today that really starts to force people to factor in more negative news? I don't see no deal Brexit as being a strong possibility, partly because Parliament's against it, partly because they're passing legislation to try and block it, and partly because if more than 75% of Parliament is against it and the EU is against it and we have the powers to invoke it unilaterally, how does something like this come into force accidentally? I don't buy it. But obviously from a market's perspective, if it's on the table, the risk has to be factored in, and I think that's what we're seeing. So I think if we get towards these kind of 127 levels, I wonder if we start to see prices stabilize around here. However, if we do break through here, then 125 is the next level of interest. And again, to see us bring below here would come as a massive surprise for me, just purely because at this very moment in time, nothing can happen to make no deal more likely. Euro sterling is interesting. I have moved the line higher here because we do seem to have established new resistance here around the kind of 90 to 91 level compared to the levels we were looking at previously. But 90-91 just does seem to be strong resistance here. We did kind of hit a double topping pattern here. So you can see the topping coming in around these kind of 90-65s, the neckline coming in here around the 89-30s, which is prior resistance, turn support. We've broken through these levels. Typically, you would take if you take the previous high to the neckline and project it lower, that gives you a possible price projection level with these double tops, and this would suggest potentially move back to around the kind of say 88 kind of levels. Not the most ambitious of moves, but again, I can't stress this enough. This is not a normal market. The pound's not reacting to normal movements. The pound is very volatile. We could hit this 88 level in no time whatsoever, leading up after the vote tonight. But don't be surprised if this just gets untangled as a result of the voting later and the hysteria around it. So here you see one of the casualties of the flash move in the yen a couple of weeks ago. So the yen actually rallied quite strongly on strong risk aversion, on very low liquidity, and we saw this across a number of markets. Those that were more heavily impacted were the yen from a safe haven perspective, but also then your beta currencies, your high yield currencies such as the Australian dollar, which you can see here. We saw a significant drop lower here. Now, this was playing out quite nicely prior to this. We were over around the kind of 74 levels, and I was saying that this was looking nicely bullish following this breakout. The risk aversion towards the end of the year really did weigh heavily, though, on it. Again, this is very much a risk-correlated currency, so when risk aversion does sap out the markets, we start to see strong risk aversion and the risk-averse movement in the yen. It's hard to really pay. It's hard. It is something that's extremely difficult to ignore. So when we broke lower, it really did just untangle effectively everything that we'd been waiting for previously. We had seen a good move, but I was hoping for more, if I'm perfectly honest, because of the move we'd seen materialize before that. I still think those higher levels can be achieved. At 75, for example, I don't think is an unachievable level even at this current state, but obviously that's a lot to stomach in the interim. So we did see more lows, and that the end of the year did really negatively impact this. I still remain relatively bullish, though, if I'm perfectly honest, ignoring this flash move candle. I'll be interested to see if we can hold on these 71.50s. If we break below these 71.50s, then perhaps it's just a move that's not meant to happen. But keeping in with my bearish US dollar view, keeping in with the fact that I think risk appetite is slowly improving, there is potential for some more upside in the pair. But again, we're just keeping an eye on these key levels. So we're 71.50. If that breaks to the downside, then I'm not going to stubbornly hold my bullish view. But then after that, you're looking at these kind of 70, 70, 30 levels for your next support. If we can break through these kind of 73.30s and even through the 73.85s, which is the 233-day simple moving average, and also that previous high, then 75 very much looks a possibility. 74.50, 75 looks that next important zone of resistance. But again, potentially getting a little bit ahead of ourselves here. Dollar CAD Dollar CAD's a bit of a strange one because this is another one that was looking a little bit soft, but we did see that rally into the end of the year. We've seen it drop off again on that mainly on dollar weakness here. The Canadian Central Bank meeting last week I thought was very interesting as well, because at one point it seemed like there was just no agreement in the markets, and I'm not talking about hold or raise or hold or cut. If you looked on certain economic calendars, the central bank was expected to raise interest rates at this meeting. If you spoke to certain analysts or if you saw commentary from certain people, they were expecting a hike. The market was overwhelmingly expecting a hold at around 85%, I believe. But the market was also pricing in a 15% chance of a cut. So you had people talking about potential for a hike. You had the vast majority of people maybe thinking that they were going to hold because of the uncertainty, and the market pricing in more chance of a cut than of a hike in interest rates. This is a dramatic change from where the central bank has been over the last couple of years, and that's why this was so interesting. And perhaps it was this sudden shift in expectations towards raising interest rates that maybe helped propel this move lower. But I do think there's a lot of US dollar weakness baked into this as well. If you look at the US dollar index, for example, it very much does replicate this move. In terms of where this leaves us now, where this leaves us from a technical perspective is very much in this longer term rising channel. And while I do remain a dollar bear, I look at these two currencies and there is a certain correlation here. We have also seen, in line with a return to risk appetite, we've seen a bounce in the oil price, which is typically beneficial for the Canadian dollar, being a big oil producer and exporter. I'm not necessarily convinced we're going to see a massive rebound continue in oil, which may potentially limit any downside. We could potentially see a little bit more. But the two economies are quite closely aligned, so it'll be interesting to see how that pans out. I expect this to be one of the pairs where the wild moves, the big upside, the large downside is more restrained, if I'm perfectly honest. But right now you're looking at this, and it's hard not to be bullish. One of the few pairs where I'm actually where the chart looks more bullish for the US dollar. We've entered into this 50.61.8 fib range. This is held for now. Obviously, that's been sold heavily into. I would love to see a break of 131 because I don't want the market to reaffirm my views necessarily. But when one of my charts tells a different story on a currency to the rest of them, I would much rather them all align. And that really references the dollar in this case. So if we see a break of those kind of 131s and this takes dollar CAD below into bearish territory, that would very much align with my view on the dollar in general. But at the moment, it's one of the pairs where I guess I'm more neutral on. I wouldn't be a strong bull, but I'm not yet overly bearish either, if that makes sense. So very much one to watch as far as I'm concerned. Sterling CAD, I'm not overly interested in still, if I'm honest. We're very much range bound. The pound's very volatile. The Canadian dollar isn't doing any favors either. If anyone wouldn't mind, I'm really just going to move on from this because we're very much range bound at the minute. We are slowly seeing higher lows come into play, so potentially there is some bullishness building, and I think that's probably the case over numerous pound pairs right now, which is supportive of that. But the pound could take 2 months to rally properly on the back of an actual resolution in Brexit here. So again, not one that really tickles my fancy, if I'm honest. This looks messy, so I really must apologize here. But I will explain what we are actually looking at here. What we're looking at is we're looking at an area where we're seeing a cluster of different indicators. But it looks extremely messy, so I apologize. The only reason I've left this purple Fibonacci retracement level on is because we ran into resistance around the 50 fib. And until we break through the 61.8 fib, I want to be keeping an eye on these levels. What I could do, I guess, in the interim is block off the 38.2, which is less relevant. But I'm not expecting necessarily rotation lower yet. I still think this looks relatively bullish, and I think if we can break through this 233 day simple moving average band, which we're trading at the top end of now, the two red ones where we failed previously, then I think that could propel us nicely higher. The reason I added the orange fib level here, and I will remove that immediately, is that when we saw a breakout here, we saw a correction, we saw some profit taking, we had a head and shoulders form here, And if you take the move from the head, 69.70, take the neckline around 67.70, that suggested once we broke that neckline that the possible price projection of around 200 pips lower. So that takes us around to back to around 65.70. We came back to around 65.70, and that's where the market rebounded higher. That also fell just below the 61.8 fib, which suggests that this was a corrective move and the market remains bullish. What I'm looking for is for confirmation that is the case. So I can remove that fib now and remove some of the mess I just wanted to highlight on the video. If we see a break of this 68.65, basically the 233-day simple moving average band, then I think this starts to look a lot more interesting and a lot more bullish. And I think these fib levels may provide temporary resistance, but I really like the look of this still at this moment in time. We'll wrap things up with the yen pairs, which, if I'm honest, are just not the most interesting for me right now. So this shouldn't take too long. Again, here's that yen flash move. It was funny. I went on. I did an interview earlier in the day, and I was being asked about possible dollar yen levels, and this was when they were trading around 110, I think 109. And I was talking about how if we continue to, this looked very bearish. Now the reason why it looked bearish was because we finally saw the break of price below this Ichimoku cloud, and that was followed very swiftly by the break of the lagging line as well, the lagging indicator here. Not only was it through the cloud, though, it was through the 55.89 moving average band, and the price had tracked both of these higher really for most of the last for the second half of the year and a little bit before. So I saw this as a very significant move, and you can see the drop off we saw immediately after that, really very much confirming this. And this came with risk aversion in the markets as well, typically favoring the safe haven yen. We held up around the 233-day simple moving average band, but it wasn't long before we broke through that. But what followed was, I was talking about 108 being a notable level of potential support because it historically has been when we moved back here. And it was only like a day later, within a day, that we saw the flash crash. Oh, and I also talked about 105 being possible below that, but it's like we may have to wait some time for that. But obviously, we saw it break through these levels very quickly. It was earlier on this that we saw these levels broken quickly, and that's where the market reversed off here. I want to make perfectly clear that is nothing to do with my forecasting, and that is not me patting myself on the back. That is absolutely nothing more than luck. So if you watch this video, please don't think that I had any expert foresight in this. This was a flash move, a crazy move in the markets in a period of very low liquidity, and it's just nothing more than luck that it broke through this 108, fell back towards 105, and then stabilized around these 108 levels. Sometimes these things can look more favorably on people's expectations than they necessarily should, and this was very much one of those cases. What's important here is that we have seen the market stabilize. So if you ignore the flash crash move, we've almost got this kind of triangle forming here. We've got lower highs and higher lows. So I'll be keeping an eye on that to see what kind of breakout we can see. Again, this is, we're talking here about two of my maybe less favorable currencies at this moment in time, because I do think risk appetite is gradually improving here, which may work against the yen. But equally, I'm not particularly bullish on the US dollar either. So if the US dollar does suffer as a result of like the improved trade talks, etc., then I think there is scope for this to move back to the downside here. We haven't seen the lagging line, for example, on the 4-hour chart break through the cloud yet, even if price has. So if we break through the downside 108, then we could slowly make our way back towards these kind of 105 levels. We could equally break higher if risk appetite dramatically improves, which works against the yen. It's just one of those pairs. Again, not one I'm most interesting. You can take that with sterling CAD as being not necessarily one of my favorite charts, if I'm honest. How strong is the 108? A pullback, perhaps. I think the 108 is an interesting level. I wouldn't necessarily say it's strong, but I would say a break below there would be a bearish indicator for that pair. But as I say, I don't think we're going to be barring flash moves. I don't think we're going to be seeing any rapid moves in that particular pair right now, because, for example, improved risk appetite on the back of positive trade negotiations between the US and China should be negative for both. So the moves may be a little bit more gradual in that case. Sterling yen, very much reaffirming the points I made earlier. This is going to be a volatile currency. if we start seeing positive progress being made in Brexit over the next few weeks, couple of months, at a time of improved risk appetite, then I think the upside could be quite significant here, but we may have to await some moves in the interim. It would suggest on this chart that 140 remains a key resistance level here, but again, that very much depends on the vote later on this evening. The two regions which look interesting for me is 136 through 140. That looks like that we could see a range-bound pair in the interim. That allows for plenty of volatility in the interim as well. So if we see some profit taking after the vote tonight, and also vote to no confidence, etc., this offers plenty of room for volatility in the interim. If we break through there, then this kind of 140, 250 area again looks interesting, being a prior level of support here as well. Finally, euro yen. I'm struggling to get into this. Same reason as dollar yen, really. The euro just seems to be battling. It wants to be the weaker currency, but it's struggling at the minute. And at the yen, it's done okay here, but I just don't see the strength in the yen to really drive this significantly lower. The flash move really exacerbated the move and exaggerated how bearish this is. But you can't underestimate either the fact that we've broken through long-term support during that flash move, and we haven't broken above. So this kind of 125 area, this is long-term support and prior resistance. Not only did we break below here during the flash move, we found resistance on the way back up. That for me could potentially be significant and suggest that this is a little bit bearish or even range bound in the interim. But until we break back above that 125, I refuse to be bullish on this particular pair. So that's all we have for today. I'm sorry I ran a bit over. I did go into Brexit a bit too much, but I'm hoping that cleared a lot up for you guys, and that you are aware of everything we can expect really tonight, but also over the next few weeks as well. That aside, please do check out all our analysis. You can find it on OANDA MarketPulse. That's marketpulse.com. You can also find the economic calendar, which we utilized at the start as well. It's also where you'll find the recording of this webinar shortly after we finish, and you'll also find it on YouTube as well. Follow me on Twitter, and that's where you can ask me any questions about the webinar that you haven't asked during the actual session itself. My Twitter handle is Craig_Forex. And also check out the other content which we're putting out as well. We put out two podcasts each week. There's my podcast, which I record with Jazz FM, who I do some of the early morning shows with. And that is called OANDA Market Insights, and that can be found on iTunes and wherever you get your podcasts. And that's released every Friday afternoon, giving a review of the week. And then there's also OANDA Market Beat. That's my colleague Alfonso, and that comes out in the middle of the week. The latest episode has just been released. But apart from that, thank you very much all for joining us. I wish you all the very best of luck with your trading, and I'll hopefully catch you all again shortly. Thank you.